thanks again for everyone for turning up. I'm going to talk a bit about Cadence Minerals. And actually, what's really interesting is the last two resource companies, the efforts and the amount of capital that they've invested to de-risk assets and to take them up the value chain is a really important point that we're going to be talking about today. Yes, we're going to talk about our investments, but I want to also maybe help people that are looking at resource investing and understanding risks and understanding where both of these assets, in the rare earth asset that's just presented before us and the copper asset, have invested amount of money invested, the timeline, and also how much they've de-risked along the way, and help us get certainty about their production path and them delivering shareholder value. So what is Cadence Minerals? Well, look, Cadence Minerals is a resource investing company. We invest in basically commodities and assets around the world. We have been focusing on lithium and rare earths. There is we are also fundamental believers and have been since 2013 when we talked about the electrical revolution, the penetration of the EVs, and the net zero achievement. We were full behind investing in lithium assets at the time and rare earth assets. But we also have one of our biggest assets that we have is an iron ore asset in Brazil, which we'll go into. But we look at strategic advantages that assets will have, their location, the management team, the technical aspect, how far they up the value curve. And we'll also look at assets that maybe are mispriced. So, for example, our Amapa asset, it was well up the advancement curve. So, we bought it at a PFS level, but people didn't see the value because it was in a judicial recovery, effectively equivalent to a Chapter 11. So we spent a lot of time getting out of the Chapter 11, and that has, we believe, accreted substantial value to us. So, and we've invested for a long time, and one will say, well, great, how successful have you been? And where are you in the timeline? This is called a Laphla Curve. For those that don't know about it, it does illustrate the timeline that to develop an asset can take. It can take up to 13 years from this conceptual stage all the way to 13 years away, to start up a production. This is an idealistic and doesn't necessarily represent all assets, but it's a good idea. It also shows that as you go up, as these guys have shown, as they go up here, their technical risk, their exploration risk, the risk that they could control drops substantially. And it's a huge risk, which we'll illustrate in a second. To get from here to get from there is very hard to do and requires a lot of effort, time, and money. And the successes are few and far between. And you obviously, as you get closer, that funding gets bigger and bigger and bigger as you get along this timeline. As we've seen, that when you get towards building an asset, it's going to cost you, for example, that rare earth asset, 300 million. Our iron ore asset will be about 400 million for construction. So I think just to see, it's called a Laphla Curve, you can see anywhere, and it gives a nice idea of a cycle to get to production, revenue, and this is increasing cost, decreasing risk. Often at the tail end here, you start to see external risks that you can't control, which include things like licensing, environmental, policy change, governments, and so on and so forth. So you want to try and mitigate those. And, our assets have, through our investments that we've done, we've invested in both publicly listed assets, European Metals Holding, which is a very large lithium asset in the Czech Republic. Strategic, why? Because it produces lithium. It will look to produce lithium carbonate, which is used in lithium batteries in situ. Again, the thematic that we're hearing is also not having been relying on geopolitical, in terms of China being the sole producer of lithium, one of the largest producers of lithium carbonate, or the largest producer of lithium carbonate in the world, and dominating the rare earth market. So strategically, it's really interesting, and it's and we've had an equity stake for a very long time and seen it all the way from resource definition to where it sits now at going through its feasibility. Hastings Technology Metals is a rare earth deposit in Australia, again looking to produce a rare earth oxide concentrate in Australia. And also we've been involved in pre-resource. We had a license and we converted it into equity. And Evergreen's very early. And then we have our two other assets, which are Amapa iron ore, which we'll talk about a bit longer, why we saw it as value. Our investment for for 30% has been 9.3 million. That's taken it all the way to PFS and through advancing the licensing so that we should get our licensing in terms of construction licensing the end of next year. And the NPV of the project at PFS level is about 900, just close to $1 billion. And then we have our investment in Mexlit alongside Ganfeng. Now, unlike gold, and to caveat on that, unlike the copper asset that you see, Mexico has declared, and this is sort of the risks that you sometimes face, declared lithium as a strategic asset, and Ganfeng is disputing that and fighting their corner to ensure that they can build and develop that. So those are our assets, and you might say, well done, you've got that all the way. What's our success? Well, if you were to take historically and look at the other assets, the major assets we've invested, there's probably, I'd add another 3 or 4 to that we've either disposed, didn't succeed, and didn't achieve. And that might seem like quite a low success rate, but when we start to look at, here's a question for you all. If we take 500 to 1,000 exploration projects, how many do we think would reach the next level, let's call it, in this Laphla Curve, to pre-discovery? And anyone for below 50%, say 50 to 50% would achieve that? Does anyone think that would be 50%? Want some interaction here? Lower? How much lower? We're going to do a TV program, up and down. Lower. 35. 35.
5% going to production.
You're a mining engineer. It doesn't work. I should have excluded you guys completely from this conversation. You've ruined it. Anyway, to get from that to what we'll call advanced exploration is about 100. 10 to 20%. Yeah? So what these guys have done, which is they've got through that, and some of them have short-circuited by effectively not having to worry about the resource and only worry about the processing technology. Others have taken it all the way up and invested the capital. The next stage is going from advanced exploration, which is sort of almost let's call that getting to this discovery and resource definition and what we'll call advanced development or development stage. So when we get to our PEAs, preliminary economic study, pre-feasibility study, definitive feasibility study, all reducing the risk as they go along. So how many do you think of that 100 get down to PEA, PFS, DFS? Don't answer.
10.
He saw the presentation, that's why it doesn't. So yes, we're already down to 1 to 2% of those early exploration projects actually only end up at development stage. Now, so how do we measure our performance? Well, we say, what we've invested in, and I said about 50% of them have got there. And look, we're not managers of these. We've identified them. One that we are manager, and we basically have a 50-50 JV, and the way that we operate is that a Mappa iron ore deposit. So that's just for you guys to understand how hard and how difficult it is, and also, average in market, it takes a long way. The next question is how many get to a mine? 1. Bingo. So it's about 1. So and that's because all those external risks can come in: capital intensity, how are we going to raise that capital, cycles, commodity cycles, etc. So how does that compare to what we have done as Cadence? That we're relatively small market cap, and our returns on our public investments have been around the 200% returns, and a Mappa. So if we look at where we are, the purchase value of our public investments have been about 4 million. The purchase value of our private, which is predominantly a Mappa, makes up roughly our market cap. But then you forget if you add in the increase in the value of the public equity that we've got, which is that's the 200%, and the value of a Mappa at our purchase, our in price at now to go from, if we would decide to go from above 30 to 49 at about $100 million a point. Values a Mappa about 100 million and therefore about a 39 million book value. So my job is obviously to talk about this and hopefully get people to invest and push that share price up. But there's certainly value there for us, and certainly we believe that's value. And if it's not recognized, which we understand in the public equity market might not be, we have to look at other sources of ways to get it funded, which is the other thing. So what is a Mappa iron ore? The Mappa iron ore is an old mine. It was discovered in the 1990s by Ike Batista, bought out by Anglo-American. There was a port failure. It produced about 6 million tons of iron ore a year in terms of a concentrate, relatively low quality, and the port failure meant that it couldn't export anymore. So alongside a $54 iron ore price or thereabouts, it was basically running the overheads, which are huge on these sort of the overheads of a railway, a port, and a mine and processing plant, were only ability to ship 3 million tons. So in fact, we went into receivership and stayed there for a while. We took it out of receivership. The reason we liked it is because the processing route was established. We own the infrastructure, which in an iron ore asset is quite rare. We own, for a company of this size, we own the port, it's ours. We have a concession on the railway to 2046. And we've taken up, through a mineral resource estimate, JORC compliant, made an ore reserve and pre-feasibility study of 949 in effectively 1 year since we acquired it in February 2022. And there's this potential to expand mine life. It's a 16-year mine life. It's an established processing route we've talked about. We're going to be doing about 5.3 million tons per annum dry. Wet, it's about 5.8. And we're doing a bit less than beforehand because we are going to produce effectively a higher quality iron ore and get a higher margin. So at the moment, 65% iron ore is around the $130 a ton, or thereabout, probably a bit more than that, $130 a ton. And the 62% is somewhere in the region of 120. And it's a fairly simple, we own this process, and then we'll ship it out from our port to, wherever. But, ultimately in our PFS, we utilize China as the main place to ship it out to. This is the transport route. It's this is the infrastructure that we will own. I would add, that although it does require rehabilitation, and that's where the capex 400 million comes from, of which 200 million is the redesign. Effectively, we've redesigned the circuit, and we are basically improving that recovery. So a large chunk of that is going into our processing circuit, and the tailings, and then the remainder of the 200 million is the port rehabilitation and the railway. And that's the infrastructure, pretty well explained in pictures. So in essence, we mine from here. We will eventually put a conveyor across here. We have a 180-kilometre railway, as I said, having a concession for that until 2046, taking it to our port, unloading it, and then shipping. These are pictures of it as it was previously operating and not now, for absolute clarification. And what does our pre-feasibility study look like? I think we just talked about it. It's a 949 million NPV. CapEx is 400, and internal rates of return are good. EBITDA over life of mine is about 235 million. And our FOB cost, that's how much it costs to take it to our port, is about $35. Take it, it depends where you ship it, but we've assumed China is the largest market. That's around the $65 a ton. And as I said, the material that we'll be selling is in excess of 120 to 130 bucks a ton at this point in time. So this is complex, not complex, but what I want to show is lots of people say that that's a big capex item. But the thing about capital intensity is how much per ton is it costing you. So this is a capital intensity. We're around here. Other assets in terms of production, the capital intensity is much higher. $300 per ton. So that's like you're talking about $3 billion, $2 billion for the capital intensity. And that shows the advantage of actually buying an asset that is already had a large chunk of the infrastructure developed, albeit there is still capital expenditure to invest. So what are our next stages, really? What we've done is we've completed the PFS. We are looking at, out of a PFS, you often come with optimizations, and so that's what we're doing. We've looked at a capital savings. We've identified that at a lower level study of about 28 million. We think we can improve the capex and the cost in the processing plant, and we think there is a possibility of increasing the resource side. I think that one we've already achieved. This is in process. We'll see how that goes depending on timing. Our objective is to bring this either with ourselves or through a JV partner, bring this to production as soon as possible. We've already completed our environmental studies or largely completed them. Because the impact had already occurred to environment, we don't have to do a full EIA. So we will get our installation license. It's expected we'll submit our reports somewhere in Q2 next year and have the installation license, that's permission to build, by 2024. And subject to our getting financing, going through a JV, we would look for a 9 to 12 month timeline for a definitive feasibility study. So those two could work together. So we could be in the wonderful situation where we have an installation license and a definitive feasibility study complete. And then, of course, we'd have to go for financing, final investment decision, construction, about rehabilitation about 18 months. So these are things that we're ongoing with the capital that we have at the moment and the resources we have. This, of course, we're looking for a JV partner to develop that, and we have a data room open, and that's ongoing. And obviously, financing construction, you'll be looking for debt financing to bring that into production. And talking about expansion, what I think I'm trying to illustrate here is having that infrastructure in your control. Doesn't matter who's going to develop iron ore deposits in that state of Amapa, you have a stranglehold on how that's going to get shipped. And even if you don't develop it yourself, you can charge substantial commercial rates to ship it to your port. And none of that economic advantage in terms of the railway, which we're going to build out to 6 million tonnes per annum, is captured in on that MPV. So, just so that you know how, we originally, this whole judicial review legal process took quite a while, and we actually only got our ownership here in 2022, and we sort of hit our targets there in terms of our investment and licensing. We've got some iron ore stockpiles, but ultimately that goes to pay back the bank creditors, and that's their dependent, and the optimization studying prior to DFS is ongoing. The development strategy is do the DFS after optimization and seek a JV partner, which we're actively to lead, to finance the DFS at the project level and possibly overall project financing. Very clear, that's 4 minutes, right. Lithium and rare earths, I think we don't really need to talk much about this. We all know that with the previous speakers, there is a shortage of these critical metals, and lithium is no different to these. As we talked about, we have a 5.8% stake in EMH. There's an excellent deposit, developing, it's strategically located, and it's going to produce a lithium hydroxide. And the pricing used in their operating costs about 6,000 tonnes. The lithium hydroxide assumption is $17,000 a tonne. I think at the moment it's sitting at $28,000 to $30,000 a tonne for battery-grade material. And we've been invested all the way to pre-resource, and it's developed very well and delivered us about 200% return. There's an early-stage exploration project, which, if we talked about some of our assets beforehand, we reversed. It was a private asset. We invested in early exploration. This is one of those assets in the high-risk strategy, but why we believe that's a possibility of having something substantial. It's right next to Core Lithium, which is capitalized about $1.2 billion. The ANT, which is the ambient noise tomography geophysics, has come back really, really positive. Geochemical samples all suggest that there is pegmatite mineralization within the deposit. When they start drilling, they will define that. But it's early stage, and if they do perform well, we get some extra stock in Evergreen Lithium, which should boost our return on that. And Haas, well, I think it's just there for reference, and I would like to leave some time for questions. But it's a hard rock lithium, completely different. So it's got to mine, it's got to produce. And we got a stake in that because we had a license and we just vended it in and took it for equity. At the time, that was a really good return. It was probably 400% return. Unfortunately, Haas has come off due to the basket price coming off a bit since we got our stake. And I think, like many stocks, they have faced somewhat of a retail sell-off. I think that's it, and leaves me 2 minutes to get questions. I rushed through that. Apologies.
Thanks very much, Kiran. Thank you. Okay, gentleman here, please. Peter. Gentleman asked a question just now. Hang on, sir.
Just a quick one. Is Meekatharra anywhere near Panawanika?
Meekatharra? You mean?
Yeah, that last slide there.
I think so, but it's Yangibana, right? Yeah, sorry. It's the Meekatharra is a town. Yangibana project. Fortunately, there's some issue with contrast. It's not the Yangibana project is here.
I spent some time in Panawanika, so.
I don't think so, but my concern is where the Yangibana project is.
Okay. Peter, can you microphone over there? Yeah, thank you.
Sorry, just my geography isn't great, but shipping from Brazil to China, isn't that like really long? Is there no steel mines nearby? I mean, steel processes nearby?
Yes, there are, and I think it's easier. So China has such a market, right? So it's just easier in your PEA or your PFS to use that as a benchmark. One of the things that we're talking about is trying to upgrade. Well, if you bring it to Europe, there are steel manufacturers, but if your product gets refused in Europe, for example, for a too high phos content, you then have to move it somewhere else, and there isn't such a large market. So for the sake of PFSs and DFSs, often using your largest market is easier because you know, and this product is sold there and sold to Saudi as well, so sold in Saudi as well. I would say that if you're able to upgrade that product above 60, well, that's like we are product 66%, you can go to, you could go to the US and that would be far cheaper. Yeah, but you know, and that also goes down the decarbonisation route because if you have higher content of iron ore, you don't have to use gas. You can then start using electric arc furnaces, which could theoretically be powered by renewable energy.
One more question, this gentleman here. Thank you.
As an investor, that was very interesting and educational, but from an investor's point of view, can you comment what would have happened if I bought your shares 5 years ago, and where do you see them 5 years forward and why?
So our performance hasn't been great 5 years ago, and I would have to say that's partly to do with an over-exuberance in the market. At one point, there was a name change, and you know we had an asset base of somewhere in the region of whatever 20 million, or even more than 5 years, 10 to 15 million, but a market cap of 80, right? So there was always going to be rebalancing of that. What I can see for us going forward is, you know, when we look at the market cap and our asset value, and I can see upside, and ultimately what we're trying not to do is trying to dilute shareholders by you know, investing into the DFS, bringing in a JV partner to do that, and take a dilution at the project level. And of course, if there are acquirers to looking for an asset in Brazil, which would be General Brazil, that would be something we would look at as well. Don't ask me the price because I don't want to sort of give away my commercial position on the sale of something like a mapper. And that would then come back to us, return it to shareholders, a portion of it, and reinvest again. So we are an investment company, that's what we do, and I would hopefully, if these assets come to fruition, we would see an increased share price. If we look at some of the analyst notes from WH Ireland, Edison, and Kemeny Capital, the valuations that they are talking about is somewhere in between, off the top of my head, a 30p price or thereabouts, up to an upside of 74p price, and we're at somewhere like at 8p at the moment.
Thank you.
Kiran, have you got many institutional investors on board?
So if we take our register, we have about a 6%, 7% institutional holdings, and that's through one of our non-executive director, which advises several institutions and have invested and still hold. Management has bought in the market and hold around, I think, on top of 2 or 3% of the holding. Anything below that is predominantly retail.
Okay, good. We touched on with Rambo earlier on about the importance of copper and with Orico. So how important is iron ore going to become over the coming?
So iron ore is much more of a stable commodity. Let's call it mature, and its growth has been traditionally driven by China. I don't see so much growth to be driven by China. I see it elsewhere, India and the Far East, and that's, well, I would say commodity forecasters, who are far better equipped than me to say that, would suggest that it's there. I don't see another boom in iron ore or boom and bust in iron ore coming anytime soon, where we saw $200 a tonne for a 62% and then back down to 50. A lot of that iron ore has been consolidated into the very large producers like Vale, Fortescue, some of the, and obviously many others, but in Brazil, Vale. But I see it's going to be more linked to economy than let's say something like lithium, rare earth and copper coming through, where there is a new use for the material, a new use, new demand, fundamentally change that supply dynamics. So it's more of an economic bellwether rather than, so for us, it's good. We bought it cheaply. We can see a revenue stream and can see a development program.
Okay. And just finally, as you said on your first slide, I think, it could be up to 13 years to start up to production. Mm-hmm. Are you looking at any particularly funding rounds in the near future?
So I illustrated that because we're not anywhere, well, apart from the early one that we are, and that's not us to fund. So, for example, the Evergreen, they've already raised their 7 million, which will take them to, let's call it, advanced exploration. Mm-hmm. And if they're successful, they'll go that way, and then they'll seek to fund it there. We have got a equity interest, which if they get to, there's some KPIs, if they hit that, we get payment in shares. So that's a bonus for us. So we don't see any funding requirements for those public equity because we are equity shareholders and we could decide to participate, probably not at this point in time. In terms of the Amapa asset, as I said, we've got the capital to fund those parts that I talk about under optimization studies and the environmental permitting. We're certainly looking and embarking and have a data room open for the development of the DFS and hopefully project financing.